Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. I'm giving my monthly discussion of monetary trends and the implications for the world's economy. Having said that, a big talking point for some time now has been the deterioration in inflation in the United States, and I want again to focus on that. If inflation in America does increase substantially from here, then that will alter the macroeconomic prospect dramatically in coming quarters, and so it's important to follow what's happening on that front. It's September 2021, so it's over a year since the explosion in money growth in the USA in spring last year, and the Institute has been concentrating on the implications of that money explosion, and indeed forecast back in the middle of last year that the USA would have an inflationary boom, and that is what's going on. Now, I'm going to be talking quite a lot about the Federal Reserve, and I'm going to be saying that the Federal Reserve really isn't on top of the situation. But let me just start with reminders of just basic points. Inflation is caused by excessive growth of the quantity of money. Roughly speaking, over periods of 5 or 10 years, the growth rates of money and nominal GDP are similar in all countries, including the USA. And so the fundamental reason for the US inflation problem, and it is a problem, is to be sought in the money growth patterns of the last year or two, and particularly the explosion of money growth in spring of last year. And that's true even though there was the pretext, the justification of the COVID-19 virus. To get inflation back down to 2%, US money growth needs to fall to, say, between 3 and 5% a year, or 3 to 5% at an annualized rate as we follow the figures month by month. In the first 7 months of 2021, the annualized growth rate of broad money in the USA was 9%. It therefore is still too high. We've been correct in this, even though certainly last spring and summer we were in a minority. And we'd like to emphasize that one reason that we can be confident that money has been the cause of rising inflation is the contrast between the USA, where inflation is taking off in a very marked way, and other countries, which also had a money supply upward blip, but not on the same scale as the United States. A year ago, the Federal Reserve's key operating committee, the Federal Open Market Committee, was expecting inflation at the end of 2022, excuse me, I've got a cold, on the so-called personal consumers expenditure deflator. That's a rather more sophisticated measure of consumer inflation than the consumer price index. It was expecting the inflation rate on that PC deflator to be 1.5%. But obviously it's had to adjust to the facts. And at its June meeting, with the minutes came a macroeconomic forecast saying that at the end of this year, there'd be inflation of 3.3%. In the next few minutes, I'm going to cast, not just doubt, I'm going to say this forecast is rubbish, but the July meeting of the FOMC again had some minutes, and with that there was a paragraph which I'm going to quote. The staff's near-term outlook for inflation was revised up further in response to incoming data. Yes, they've been way behind the actual, their forecasts have not been in line with reality at all. And the staff expected the increase in PCE prices to move down gradually in the second part of 2021, reflecting a moderation in monthly inflation rates and the waning of base effects. And even so, PCE price inflation was projected to be running well above 2% at the end of the year, i.e. in line, say, with the 3.3% they were talking about just a few weeks earlier after the June FOMC meeting. In other words, the question of what is the FOMC thinking, they're expecting this moderation in monthly inflation rates and waning of base effects to deliver inflation on the PCE deflator of 3.3% at the end of the year. Okay, now, I wonder whether these people are really thinking at all. Because just a fortnight or so back, when this video was prepared, 27th of August, the Bureau of Economic Affairs published its latest monthly release with the PCE deflator for July. And the increase in that index between December 2020 and July 2021 was 3.2%. Well, look, there's still 5 months of the year to go, all right? We've already used up all of that 3.3% that you can, if you think I'm making this up, this is just a little copy of that, the key part of the release. You can see the increase between those two numbers up in red. In other words, the FOMC, the Fed's key operational committee, Fed being probably the world's major central bank, they just don't seem to be able to count. They're saying, in effect, that after having this clear upturn in inflation so far in 2021, there'll be no inflation in the last 5 months of the year. Well, let's just try and look at some evidence to give them their due. The increase in the consumer prices in August was a bit lower than previous months at 0.3%, but let's just look now at some other indicators of inflation. This is the producer price index, USA. It's a 3-month annualized rate of change. This is not an annual figure. It's not affected by the base effects. All right? It's a 3-month annualized rate of change. And you can see that it's accelerating at the end. On that basis, inflation will not be slowing down in the second half of 2021, whatever the better news on the August CPI. Then just look at business surveys. This is a survey from the very well-regarded Institute of Supply Management. It's been producing surveys for many years, and it shows the balance of companies that are finding prices are going up in the services part of the US economy, which of course is the dominant part. And you can see that it's at a peak for the last year or 15 months or so. But manufacturing, similar ISM index, has come off a little bit in the last few weeks, but only after a continuous surge since early 2020. These, I suggest, are signs that, in fact, inflation will be persisting at high rates in the second half of 2021. And I would, for myself, suggest that the increase in the PCE index by the end of the year will be between 5.5% and 6.5%. And the consumer price index, despite the good August figure, will actually end the year with an inflation rate of between 6.5% and 7.5%. And we've only now got a few months to go before we can check on that. I think I've shown you, what else I've done, that the Federal Reserve's views on these matters are not worth the paper they're printed on. They're just nonsense. What about 2022? Well, to be clear, as before, there is a clear relationship between the growth of the quantity of money and the growth of nominal GDP. In the year to mid-2021, the quantity of money rose by 35% in the USA, more or less. Therefore, there has to be some period, over a number of years, in which that very rapid money growth is going to be coming into the economy, asset prices, price of goods and services, and then into these various official price indices. This is a process that's subject to lags, Friedman called long and variable lags. Inflation is likely to be running at a higher rate in 2022 than in 2021. In that sense, the current US inflation is certainly not transitory. The part of the argument, standard macroeconomics, that the demand to hold money is stable, and so the velocity of circulation of money is mean reverting. Velocity collapsed last year. It'll rise rapidly in 2021, 22, and 23, and that'll then come through into the inflation indices. May I just say here that it's very important, just a couple of points, to recognize that the economy is interconnected. Everything affects everything else. Money affects both asset prices and the price of goods and services. The asset price inflation that we've had in the USA since spring of last year has been caused predominantly and clearly by the rapid money growth. Now, the notion that this can be attributed to bottlenecks and supply shortages is absurd. There is an emerging contrast between the USA, which had the highest money growth last year, and other countries which may have had an upward movement in money growth, but nothing to the same degree. What's turning out is that inflation is higher in the USA than in Europe, and higher in Europe than in Japan. Fits exactly with the money growth pattern. Let's look at these asset prices. This shows you the increase in US house prices. It's one of the key asset prices, isn't it? I mean, it's, for many people, a house is the most important asset they own. And you can see what I've got here is both 3-month annualized rate of change, which is blue line, and red line is the annual rate of change. The key point here is that the last number is, I think, for May, maybe for June, hang on. No, it's actually for June. These things are published a little bit with a bit of a lag. The price increases, I'm sorry, are accelerating at the end. So the positive effects on demand of the house price acceleration, the fact that people are wealthier, will be intensifying in coming months and quarters, not going away. All right? The stock market, in a way, one hardly needs to talk about. The stock market, something like 5 times higher than it was a decade ago, has fully recovered its losses in March last year. It's now much higher than it was then. In fact, the Nasdaq is about 60% up on its levels even before COVID was being reported. So, try and summarize that. The Federal Reserve, it appears simply not even to be thinking, quite frankly. It is now overwhelmingly clear that inflation at the end of this year is going to be heading towards 10%. Certainly it will be somewhat above 5% on both the PCE inflation measure and on the more commonly watched consumer price index. And then inflation, second key point, inflation will be higher next year than this year. I'm just going to, before I finish, say that, this has been an extraordinary kind of episode. It was implicit in the money supply explosion of spring last year that this sort of inflation takeoff would occur. And I did, in fact, even in April last year, suggest that the return to medical normality would be associated with bottlenecks and supply shortages. It's always the case that some prices are rising faster than others. That does not mean you could ignore general inflation. Thank you again for listening. I'm sorry I had a cold, but I think the points I'm making are pretty important. Thank you.